Ready to catch the next giant wave in the market? If you want actionable, practical picks for August 2025 that give you resilience, growth, and real dividends, this is your board. I'm not just tossing you a list today. I'm breaking down why these 5 companies stand out, using fresh data, real-world context, and those famous surge sparks to make sense of the numbers. If you want your portfolio to ride high, all year, all weather, stick with me to the end. Let's kick it off with a quick check-in on what's actually moving Wall Street right now. Here's the vibe. The S&P has steamed past 7% gains for the year. Tech stocks are back in charge, and energy names are roaring after supply shakeups. Inflation's just below 2.5%, and the Fed is pausing for now, eyeing every global headline for their next move. Volatility's the name of the game. But inside that noise, pockets of real opportunity, if you know where to look. In 2025, the winners will balance growth, cash flow, and quality. And that's where we start our top 5. First up, Microsoft. Ticker Microsoft. The share price right now, around $430. Dividend yield of 0.8%. Second quarter revenue, $71 billion, 12% year-over-year growth. Their cloud and artificial intelligence segments now make up over half of all sales. Why does Microsoft stay on top? Simple. It's not just Office and Windows. It's Azure Cloud for businesses, Copilot for AI, cybersecurity, and a never-ending list of smart acquisitions. They're everywhere, powering your work laptop, your home device, even a backbone for entire governments to work safer and smarter. Here's your surge spark. Think of Microsoft as the digital world's landlord. Every click, every scroll, someone's paying rent to Redmond. And when you own the shares, a slice of every dollar flows to you. What's the big catalyst? AI is driving another tech revolution, and Microsoft's the engine. Its Copilot integration is going head-to-head with Google and Apple in offices worldwide. Risks? Sure, the stock isn't cheap. 32 times earnings is a premium, and tech always gets wild swings. But if you want both growth and stability, Microsoft is an anchor for any modern investor. Next up, JP Morgan Chase. The ticker is JP Morgan. Here's what the numbers look like. About $203 a share. Dividend yield, just under 3%. Annual payout, nearly $6 per share. Net interest income up 6% year over year. Return on equity, leading its peers at 17%. Why pick a bank in 2025? Because loan demand's rebounding and the digital push is finally paying off. JPM's handling risk with a fortress mindset, and their digital banking is light years ahead of old-school rivals. Picture this, the surge spark. JP Morgan is Wall Street's Main Street. Every home loan, every Fortune 500 deal, every mobile tap, they're taking a slice and writing you a dividend check. Key catalyst? They're going big on digital assets and AI-driven fraud protection. Their loan book and wealth management pipeline are growing, but with risk controls only a giant can manage. Risks? Any bad surprise from the Fed, changes in regulation, or rising loan defaults could shake banks. But with their scale and experience, JP Morgan still sets the bar for safe, compounding income. The third name, Procter & Gamble. Ticker PG. Let's break it down. Trading near $175. 2.5% dividend yield. 69 straight years of dividend hikes. That's older than most investors. Last quarter, 8% organic revenue growth. Brands include the classics: Tide, Pampers, Gillette, Oral-B. You've used one today. What makes PG a buy? No matter what's swirling in the markets, people still clean, wash, shave worldwide. They raise prices and keep customers, growing in emerging markets, delivering consistent profits. Here's the surge spark. If your home runs on soap, razors, and detergent, your wallet should too. Every little daily routine suddenly starts paying you back. Major catalysts? They're leading direct-to-consumer digital sales and going green wins over the next generation of shoppers. Risks? You'll rarely find PG cheap. And while it won't skyrocket in a tech rally, it's a rock at the core of any dividend portfolio, reliable and built to last. Fourth on the list, NextEra Energy. Ticker NE. Current price? About $87 a share. Dividend yield? Nearly 2.8%. Fastest growing renewables utility in the entire U.S. 11% annual dividend growth over a decade. Show me another utility that can say that. Their portfolio? Florida Power and Light, plus enormous wind and solar farms across the country. Why buy NE now? Clean energy isn't a trend anymore. It's the national grid. NextEra's steady utility business lets them keep expanding wind and solar, all fueled by government incentives and unstoppable demand. Here's the surge spark. NextEra is the silent engine under our economy. Every new solar roof, every spinning turbine, a little more cash flows to you. As the world transitions, you get paid for the green evolution. Key catalyst? Federal support and early mover advantage lock in growth for years, while retiring fossil fuel plants gives them more room to run. Risk? Changing regulations or delays can ding short-term results, but their pipeline and leadership are hard to beat, especially for long-term, rising dividend income. Last of the main five, T-Mobile US. Ticker T-Mobile US. The stats, about $196 share. Dividend yield, 1.5% just launched. The nation's fastest wireless growth, leader in 5G rollout, rural expansion, and churn rates at record lows. Free cash flow last quarter rose 23% year-on-year. Why is T-Mobile still a buy after so much 5G hype? Because it's not hype anymore. The Sprint merger gave them scale. Now they're throwing off cash, rewarding investors, and already talking about leading on 6G. Surge Spark? Imagine every photo upload, every Netflix stream, every emoji. T-Mobile gets a piece, and you get paid for the endless appetite for data. Key catalyst? Their massive spend on network densification means even more locked-in customers and a fortress against future competition. Risks? The price wars in telecom can shrink profits, and 6G will bring big expenses. But their momentum, smart execution, and new dividend policy make this an income growth hybrid with room to run. For extra punch, here's a side wave for risk-tolerant surfers. Two small caps on the watch list. First, Enphase Energy. They make smart solar inverters for homes, right at the heart of the clean energy boom. Their new battery tech could ramp up profits, but expect a rough ride if the solar cycle sours. Second, Celsius Holdings. The fastest expanding energy drink in America, using fitness influencers and smart partnerships. Growth is explosive, but so's the volatility. Warning, these are for the bold. Never make small caps more than 10% of your portfolio unless you've got nerves of steel. Let's tie it all together. Diversification is still king. Don't throw everything into one hot pick. A smart mix of blue chips, steady dividend payers, and a speculative sliver is where real longevity comes from. Best way to buy? Dollar cost average in. Set your recurring investment in these top names, weekly or monthly, and let time smooth out the bumps. If your broker offers drip, turn on, and reinvest those dividends for compounding magic. Let your share count and income grow automatically, rain or shine. And finally, monitor but don't micromanage. Glance at updates every quarter, rebalance after big moves, but don't let headline panic break your discipline. Let's make this real. Picture Ethan. He started with $1,000 3 years ago, splitting it across Microsoft, JP Morgan, and a taste of NextEra. He added $200 a month, left dividends on drip, and never sold during dips. Today, his account's bigger, his income's rising, and he's not losing sleep over hot stock tips. Just simple, steady, relentless compounding. That's the Dividend Surge way. Build wealth over time, not overnight. A quick word of honesty before we wrap. All investing carries risk. Even the best companies can take a hit. Market panics, regulation, threats from competitors. For banks, keep an eye on loan losses and new rules. For utilities, politicians, and regulators. For tech, stay ahead of the innovation curve. For small caps, brace for wild swings. Most importantly, never chase too good to be true dividend yields. If a payout looks suspicious, dig deeper or move on. Smart investors check their holdings a few times a year, rebalance when needed, and never bet what they can't afford to lose. FAQ Lightning Round. Straight answers to your hottest questions. Should you buy all 5 stocks at once? No hurry. Build positions gradually. Learn as you go, and never buy more than you understand. How often should you check up on your stocks? Once a quarter is perfect for most investors. Annually, rebalance if one stock grows way out of proportion. Are ETFs safer than individual stocks? ETFs give instant diversification and cut risk, but quality stocks can still deliver an extra kick for growth or dividend income. Both can work. Just match your style to your goals. Red flags to watch for. In banks, watch for rising loan losses. Utilities, regulatory headaches. Tech, falling behind in AI or cybersecurity. Consumer goods, shifts in what people buy or margin collapses. Best way to use your dividends? Turn on drip in your broker and let the snowball do its thing. Your income rises, and so does your share count. So, here's the summary. Microsoft for tech backbone and AI. JP Morgan for the biggest and the safest cash flows in banking. Procter & Gamble for reliable growth that you use every day. NextEra for clean energy mega dividends. T-Mobile for a new era of income and data. Stay patient, stay diversified, and let your money ride out the waves, not get sunk by every headline. Now, your turn. What's your number 1 stock pick for August? Drop it in the comments below, and let's build out the best dividend community on YouTube. If you learned something new today, hit like, subscribe for more, and keep surfing those dividend waves until next time.